Well, not all of us are unhappy with our work. Jim Russell, you, of course, you and I just love what we do, right?
You know what, I got to tell you, in all honesty, working with U.S. Bank, the people at U.S. Bank, working with the customers is really great stuff. I get out of bed every morning. It's really a great day ahead. Great stuff. Steve Mullen, Mike Prescott run a great show locally.
And of course, you love working with us on U.S. Bank Business Watch as we do with you.
I understand.
Jim, of course, is a senior equity strategist, and this week we're looking in our Economic 360 at the fourth quarter earnings reports. A lot of companies looking at numbers now. What are we likely to see in those numbers?
You know, Brian, this is a really important earnings season. But not only does it tell us about the period behind fourth quarter 2013, but it also previews what is likely to happen in 2014. And there's some really telling data that we're looking at. First of all, the data would indicate that we're going to see earnings that are likely to be up 8% year over year. That's a pretty good number. And you can see that from the chart there, it is an all-time high. There's some things in 2014 that are very likely to change. Europe is likely to be a positive, not a negative, and of course it's been a negative for really this last several years. Secondly, the government shutdown is unlikely to rear its ugly head. And third, bad weather is also unlikely to hit. So we're likely to see many of these things hit on a positive note, and we're likely to see a much stronger 2014.
But earning growth is a key driver of the markets. So, you know, what are your expectations? Are they high or low, and how do you think the markets would react?
Well, you know, earnings expectations by investors are really pretty low for the fourth quarter, and the reasons I just gave: bad weather, government shutdown, fewer holiday shopping.
Looks like an EKG, doesn't it?
Yes, it would make some fall out of bed a little bit. But what this is a chart of is the negative pre-announcement ratio, meaning that the higher this line goes, and you can see it says about as high as it has been in recent years, the more negative or the more cautious investors are about the fourth quarter earnings. So the story goes that if earnings expectations are very low, it's very easy for companies to exceed or beat those expectations. Usually as that happens, the markets tend to trend up a bit more.
So what areas of the economy are anticipated to be weak and which ones strong?
Well, we really see a shift beginning in the fourth quarter 2013 and carrying on into 2014 in that shift. What has really worked up until now are the interest-sensitive sectors of the economy: housing and autos. But what we're going to start to see is a broadening of that strength. We're going to see the financial area part of that recovery in the fourth quarter, also telecom. Now, importantly with the financials is mainly the insurance companies. The insurance companies reported really soft earnings last year because of Hurricane Sandy. Now, there's a couple of other things that I think are worth noting in terms of the weak sectors, and those would be energy and telecom. What we're seeing there is really energy and utilities, seeing really the influence of energy price swings in both of those sectors, and probably likely to see negative earnings growth in each of those two.
All right, Jim, we'll keep an eye on those with you. We appreciate you and U.S. Bank.
Thank you, sir.